Where are you today?
Silver Spring, Maryland. I'm about 20 minutes away from Center City, Washington, D.C.
20 minutes like during the inauguration or 20 minutes on a Sunday morning at 7 a.m.?
That's a very good question, right? No, 20 minutes at about 1 o'clock in the morning on a Sunday. Because the traffic in Washington, D.C. is getting such that 20 minutes will turn into an hour and a half on any particular commute into Washington. So, yeah, very perceptive and good point.
Did you grow up there?
No, I grew up in New York City, um, in the Bronx in New York, and I guess I moved around here right before my high school years started. From at which point I went to school here, and then I went to law school actually in Syracuse. So back to New York. So came to Washington, then back to New York. Went to the University of Maryland, and then went back to New York State to study law, and then I came and made Washington D.C. my home. So back and forth from between New York and Washington. That's been my.
Have you ever traveled west of the Mississippi? Because it's like that whole another part of the continent over there.
It sure is, and we only focus on what's around us. The Yes, I have, thanks to having been part of the Mortgage Bankers Association for such a long time, and the American Bankers Association, and being on all of the conferences, and so I got to visit a lot of cool spots. I just came back now from, even though this is not on your side of the Mississippi. Went down to South Carolina, to Charleston, South Carolina. What a charming city that you would not otherwise see, perhaps if you're not there on a conference or some other event. But I would recommend that for a weekend or a whole week to anyone.
A friend of Rob and I's, Mike Metz, moving to Charleston, South Carolina. New development in his life. Yeah. Yeah.
Really?
Yeah, absolutely. So he's got some family there and yeah, deciding to make the move of course, the Chrisman famous Mets Market Minute.
Yeah.
So yeah. So
Did you guys stay at VIP?
yeah, yeah, absolutely. Yeah. So nothing changing there, just changing addresses, heading east. So
Let's go visit.
there you go. All right, well, let's go ahead and get into it. This is the big picture presented and sponsored by our friends at Depth. 20 years of so ably serving the mortgage lending and fintech space for strategic communication, brand management, public relations. If you need your story told, Depth, the people to do it, depthpr.com, a great organization and great people, more importantly, and a great partner of the show. And my name is Rich Swerbinski with Onward and Upward Consulting, and as always, join my esteemed colleague and co-host Rob Chrisman. Rob, how you doing today?
What time is it? Oh,
It,
I'm sorry. Sorry, Rich. I was just warming up for your question. I'm sure you'll ask me about Trump and the tariff policy, and I'm practicing my answer.
there you go. I know how much you love Trump questions, so getting a little early practice in. So, Rob, good to see you.
You too.
And and this week, very pleased to be joined by our friend, the Senior Vice President, Mortgage Finance for the American Bankers Association. Also spent a bunch of years at the MBA, some years at HUD, very decorated past and experience in our industry. Rod Alba. Rod, great to see you today.
Hey, good to be here. And you know, notwithstanding all those years, it's still very confusing as we
Maybe more
delve into.
confusing than
Yeah.
ever, right? You'd think you'd seen it all with stints at MBA and HUD and, of course, the ABA now. But, it's a new day and an uncertain future ahead. And good segue, Rob, because as always, as has
Hang on. Rod, have you ever worked for a company or an organization that isn't made into an abbreviation?
Yes, as a matter of fact, I did work. I had a small stint with a oh my God, the sin, a subprime company, back in the day. And, when we all believed that the subprime mortgage would offer the promise, and would give every American a chance. And I think that with that promise, I sort of went into try to help there. And so I worked for AmeriQuest Mortgage for, let me see, about 4 years until, the great date of 2008 came along, and I think we all had to go to greener pastures.
You weren't in charge of that ad campaign, were you?
I was the guy holding the bleeding cat. I don't know if you remember that.
Oh yeah. I I frankly, I mean, that was a masterful set of ads.
Yeah.
Just the cat and the guy dropping his daughter and her friends off at the convenience store, and the guy with the dog in the park. And yeah, I run those. I run that clip every well, periodically, about once a year. That's set. It's
Yeah,
great,
yeah.
great ads.
There
All
we
right,
go.
go
So,
ahead,
Rob,
Rich. Go ahead.
your favorite part of the week, the rundown of the top news, Rob, and as usual, no shortage of options to sift through here. Your buddy Sarah Middleton and the Supreme crew on another acquisition, Michigan Mutual, retail and wholesale lender, obviously based out of Michigan. Rumors of a guild in Bayview union percolating through the industry. We got Bill Pulte going on the offensive against FICO, was a little bit more aggressively this week. And then, of course, President Trump and his declaration to take the GSEs public, and a little added fodder to that this week when he said he's going to be keeping in place the implicit guarantee that obviously everybody was worried about rates spiking as they, if and when they go through this process. So, Rob, your thoughts on all that to get the show started here today?
I received an email today from somebody who will remain nameless, who said, it's wonderful how this administration is as flexible as it is.
Was it Matt Ishbia? Matt Ishbia send you that email? No.
No, I didn't get an email from Matt today. Uh, the Yeah, GSE. I wrote a lot about it today. The entire industry is dealing with Bill Pulte last Monday telling an audience in New York that we're looking at working on this in 2026, to be changed a day or two later by his boss Donald Trump, saying we're going to work on this now. And then Donald Trump coming out a day or two ago, talking about what you mentioned there, and that is a big fear in the industry because the uh, the big question is what is going to differentiate Fannie Mae and Freddie Mac versus, say, Deep Haven or Angel Oak or AmeriHome or Verus, eResi, whoever it might be. And obviously, those companies don't have, when you talk about securities that are issued by ACC or A&D or whoever, there's no talking about a government guarantee. In fact, they explicitly say these are not government backed loans. And even with Fannie Mae and Freddie Mac, there's a question about where that government guarantee will be, explicit, implicit. Much easier said than done. I think when you talk to anybody in capital markets or any regulator or any politician or anybody in the MBA, it's a very long process, a lot of moving pieces, and that guarantee is part of it. And if you are a bank, let's say, Rod will talk, I'm sure, a little bit about this, but B of A or Chase or somebody like that, and to be competing in effect with Fannie Mae and Freddie Mac, who have a government guarantee guaranteed by Donald Trump, it's a different playing field. It's not quite a level playing field, and so it'll be interesting to see how that plays out. But that is a big fear in the market, that Fannie Mae and Freddie Mac will just be cut loose, and what will that do to interest rates? Because obviously, investors out there, money managers in other countries or this country, they want to know, what they're buying. And if is the pool of loans that they're buying or the whole loans that they're buying, does that have some kind of government guarantee or not? Because that determines what yield they are required to earn on uh, on those pools. Thank you, Ira, for that note. Yeah, good discussion in my commentary today. The I think if they can pull it off, great. If they can't, or if things happen haphazardly, not that this administration would ever do anything that is haphazard or sudden, or isn't, recanted a few days later, saying that tongue in cheek, um, then we'll see what happens. But the fact of the matter is, as everybody on this call knows, we are dealing with an industry that is dealing with tens of millions of borrowers out there, right? Trillions of dollars of securities. And that is not to be taken lightly. So I think the hope is that the process, which is pretty much going to happen now at this point, but that the process is carried out in a thoughtful, well documented manner that stakeholders have a say in, rather than uh, one or two people just proclaiming that this is the way it's going to be, because it's a very complicated environment. So we'll see what happens regarding Michigan Mutual and Guild and Supreme and Bayview, and I think the M&A, as I noted also in today's commentary, the M&A business is alive and well. We'll be hearing about mergers and acquisitions for months, if not years to come, because frankly, some people are better at creating companies and others are better at running them. And sometimes the people creating them, they want to get out of the business, they get old, they just are tired of the game, they don't want to go through another business cycle. And so they find a good partner, and a deal gets done. And oftentimes the acquirer is better at running a company and growing it rather than the startup skill set. So yeah, it's just going to be, I see no stopping mergers and acquisitions going forward. That not big, huge names like we see periodically, but oftentimes it just happens at the branch level or even the loan officer level. Loan officers will change, branches will move, and tiny companies that we never hear about will continue to move for whatever reason. So yeah, it's just a sign of the times.
And Rod recently had the ABA's American Mortgage Conference. I think it was before Trump said anything about. Was it before Trump said anything about taking the GSEs public? I think it was just
Yeah,
before
it was,
was
it
your
was right
conference.
before.
Yeah. So I mean, what say you to the members that are worried or wondering aloud to you what to make of what's going on with the GSEs from the bank side of it? What are you telling them?
Yeah, so first of all, my compliments to Rob. If you guys haven't read his piece this morning, I think it's succinctly and with some amount of humor, I don't know, hidden humor, sort of tells the story of what's happening here. I mean, you really did it well, and I think that you bring up a lot of the issues, a lot of the problems, a lot of the conversations, because I will agree with you. We are at the cusp right now of of augmenting our conversations about what's going to happen, and I think what is important here is not what the president said necessarily. It's the fact that he said it. It's the fact that, for the first time, we have a leader that has put this squarely on the table and is saying, we are going to talk about this. And I think that you're seeing sort of some of the congressional leaders respond to it. So I wouldn't pay too much attention about what is being said. You caught this in your write-up this morning, Rob, about, the fact that we have a president now that says that he sees that there's an implicit guarantee. And by God, he wants to keep that implicit guarantee in place. Well, what does that mean? What does it mean that you're going to keep an implicit guarantee? I don't know what it means, and I'm not sure anyone does, other than to sort of understand that, there's some sort of hybrid that's coming here. There's some sort of arrangement that he's going to come in and maybe surprise us all, and maybe at minimum, he's going to have us all in a good, long conversation. So, to everyone out there, yeah, I will say that the conversations in earnest, will begin now. And I think that the Mortgage Bankers Association, the American Bankers Association, everyone, the realtors, NAR, the investors, are going to be involved. And one of the things, Rob and Rich, I think that's important, something that they said is, hey man, we're looking for solutions and we're looking to sort of let these guys out and finally free them from their current state. But if this brings a shock to the market, if it increases interest rates to a point that we don't like, I think that they seem to be very willing to hold back. Rob, I don't know if you read the same thing, but that is sort of a promise to the world that we're not going to get crazy here. We're not just going to advance, regardless of the destructive torpedoes. I think that they're going to be careful. They're going to engage in conversation. And they're going to get the sentiments and the temperature of the private market before they do anything.
Yeah, I think Donald Trump is very good about knowing where investors' minds are, whether they are investors in Fannie Mae and Freddie Mac or money managers and so on. I think that he must realize that Fannie Mae and Freddie Mac are uh, the reason, for example, why a 30-year mortgage exists. Although the 30-year mortgages originally sprang out, I think, FHA, but Fannie Mae and Freddie Mac definitely made the U.S. financing system a model for the world, and you wouldn't necessarily want to throw that away. So I hope you're right. And you're right. He has put it squarely on the table, and let's figure it out.
Hmm. Yeah. Yeah. I would just say that, it's sort of like when your in-laws call you and they say, hey, we want to come over and visit you guys. You don't run to the kitchen and put the lasagna in. You're gonna wait a little bit, right? Right. I
I like
heard you say that, you think this is gonna roll, and I think you're right. Okay, so personally, at a personal level, I think you're right. But I just have to say to myself, wow, I remember saying that same thing about 30 years ago. I remember saying that there was going to be GSE reforms about 25 years ago, and I remember again saying, maybe about 3 or 4 years ago, this got serious. But it just seems to always roll itself like a turtle into its shell, and it just sort of stays there. So I trust that your wisdom will bear fruit.
Yeah, it's interesting because if you look at what else is going on in other parts of the mortgage business, for example, the portfolio products that banks and credit unions offer, the non-QM segment, the non-agency segment in general, DSCR loans, ITIN loans, and you look at that market that's out there, and so many successful companies and loan officers have branched into those other sectors rather than just sticking with Fannie, Freddie product, FHA, VA, calling it a day. And the the ability to offer those products to borrowers is very, very important for lenders and loan officers. And there is talk out there, Rod. I mean, I'm just chatter, idle chatter. We'll see, but idle chatter that Fannie Mae and Freddie Mac will just migrate towards being more of an investor at that, like I said,
Hmm.
Deep Haven or Marihome or whoever it is, Chase, Wells Fargo, B of A, U.S. Bank, um, and those interest rates will creep up, and certainly in the non-QM world, rates have crept down, and in fact, for some products, actually beat the Fannie Freddie price given loan level price adjustments. So there's a melding there that's going on. I think that Fannie Mae and Freddie Mac are very relevant to the mortgage industry now. Maybe it'll be less so in the future. We'll see.
Yeah, we'll see what happens. I remember, having Mark Calabria on the show a few times prior to him getting back into the government. I remember him saying that the implicit guarantee, the way that the investor community interpreted that, was that it was like a 75-ish like percent chance of a government backstop. It was the way I remember him describing it. And if that were to erode, you still would have like, if the mortgage market were to go to hell again, what are the chances the US government would just step in like they had to in '08, out of necessity? So I remember him equating it to like the market's pricing in about a 75% chance of like the government, backstopping in chaos with the implicit guarantee. And if that were to be removed, it would be more in like the 40 to 45% range where the numbers he threw out there. But, I think another thing too is, so, keeping the implicit guarantee, which to Rod's point, what does it really mean? It means nothing now. It technically would still mean nothing in the future. But, it's should go a long way to not shocking the rate market. The other thing we all have to remember with the GSEs is guarantee fees have gone from 15 basis points to 75 in the last basically 10 or 15 years. And that has been done to recapitalize essentially the GSEs from the way I can decipher it. And if these were to be private companies, what type of guarantee fee tied to the guarantee would be brought in there? Could it make rates go down? Delivery fees are also
Do
obviously,
guarantee fees even exist?
they may not exist. I mean, I guess
Are
it
they,
depends on
we
the.
have to change their name. They're not going to be government sponsored enterprises anymore, right?
Well, it sounds like it sounds like that there would be like a bridge is the way I'm assuming, like, that they would say, hey, the implied government guarantee will remain in place for 18 months or 2 years, and then, maybe transition to something that looks different. But who knows? It's all speculation at this point. But yep, Rob.
So, um, hopefully, Rod, I'm not cutting you off here, but while all this is going on up here, you know, down here, banks, Rod sees like the banks and the IMBs and the credit, once again, having to deal with their borrowers, despite what's being talked about in the press regarding the capital markets. So you're an originator and you're dealing with this noise out there, this headline grabbing noise, and all you're trying to do is put Mr. and Mrs. Jones in a home and help them finance it. And or you're a bank loan officer and you've got a product set that you're trying to help your borrower with. Um, it can be quite a distraction that's going on out there. And if you're a Fannie Mae or Freddie Mac employee, holy smokes, it's
Mhm.
tough. It's tough to. I wouldn't want to have my company up. I don't know if the president talking about my company would be a good thing or a bad thing. Uh, because all I'm trying to do is help my bar and do my job.
Yeah, Rob, and I think what's interesting about what you just said about, what's happening within Fannie Mae, what's happening within Freddie Mac and the GSEs, one of the serious impacts that they have had, it hasn't been as bad as what's happening in the CFPB, right? Which I imagine we'll talk a little bit about here, but they've seen the entire mission staffing that they've had. And by mission, I mean, all of the additional sort of goodies that Fannie and Freddie sort of give out to the market. And in particular, I'm referring to the equitable lending, equitable programs that they had, which included language tools for lenders. It included a lot of other instructional items to sort of reach more communities. All of that has been cut out. And so now you have these, Fannie and Freddie sort of operating, at a very basic level. And I think the other thing that's not spoken about, because we're always talking about just the financing methodologies and, how they're going to sort of come out and be free and what they're going to look like once they're out. I think that the other thing that we have to talk about is not the financing methodology, but also what is their role going to be going forward, right? So all of these additional elements that they have had, all of these additional assistance programs, et cetera, that they have had, all of that is likely to get cut. All of that is going to go away. And so they are probably, this also depends on how they are defined once they come out. But I suspect that they're going to be restricted to their core mission of serving a liquidity function for mortgage period. Maybe just purchase and refi, nothing else. And they're not going to be offering all the other toys and goodies that they have had, what they've been doing up to now. So that's also worth mentioning is that whatever happens, that element is going to be defined as well.
Rod, you mentioned the CFPB and, still a little bit in flux legally what's going to happen with that organization. But I think, any outcome. It's going to be a weakened, defanged organization. Obviously, any talk amongst the members? We've talked on this show, like we've already seen some trends, some former CFPB employees, getting prominent roles with state regulatory
Mhm.
agencies. Your banking members, is there concern that, like the devil, the CFPB, wrong, terminology, but versus, dealing with individual states and more of an unknown?
Exactly right, Rich. I think so. Yes. You know, I think there's probably about five or six concern priorities that my committee has identified. We have a mortgage markets committee within the American Bankers Association, and mostly composed of smaller institutions. Although we have some of the large ones as well, and we sort of meld our views and our conversations. What you said, what is happening now is indeed is one of the top concerns. So if you were to ask me the question last year, the biggest concern would have been government. The government concerns us. It was government risk. The government was against us. The government was enforcing against us, even though we're trying to do the right thing. We're trying to reach all populations. There's no getting away from fair lending. For example, there's no getting away from just having small little mistakes in your documents that may lead to big penalties. Everyone, there was this sort of big presence of the police, and the government was mean. It was just mean, right? That was the big concern that we would have had a year ago, and that our members would have identified a year ago. Today, it's still government, but I think today the worry is political risk. What are these reforms? What does it look like? Everyone is sitting sort of like in a cave, not being able to see what is outside of the cave. We're seeing all of this stuff happening. We're seeing the CFPB go from 1,700 employees down to 200. And as a matter of fact, the leaders of the CFPB have said, well, all we really need to run the CFPB is 5 men and a fax machine. And that's a quote, right? So, I
I
think
gotta find that one.
I'll send it to you. And, the trend is that there is going to be a real shrinkage of the regulatory state generally across the federal government, right? We're just bringing down the regulatory state. That is the stated goal of the Trump administration, and by God, they are doing it, and they're doing it fast, and they're front loading it, right? As we all know, they're going to fight all the legal battles now. They're going to engage in this process now. They're going to fire. They're going to engage in rifts now, and they're going to see, the challenges and all the other elements that come up. We're going to fight that right now, so that the rest of the tenure is going to be about implementing the policies that they want to implement. So, but let me just say one thing: the bureau was created by Congress. Therefore, the bureau can only be destroyed by Congress. You can hamper it, right? You can cut off a lot of its fingers. Maybe you can cut off one arm, you can cut off one leg, but it's going to have to function. And up to now, I think that what we've seen is, yes, it's been completely quiet, and we've seen that it's been weakened, but it's going to survive. We don't think that the reforms are in equilibrium yet. They're ongoing. I think there's going to be more changes. I think there may be an addition of offices at some point. Once they bring it down to its base level, they may at that point begin to add other sort of offices, functions, whatever, to fit their policy priorities. So I think that that's a developing issue, and it's going to be very interesting to see where it goes. But don't expect that it'll just go away. So that's number one. Number two is that I think that even though we have a restrained enforcement and supervisory agenda, as you just mentioned, Rich, the states are going to stay active, right? And certainly for banks and for all institutions, your reputation has to remain alive. Don't just avoid the law. Don't just start dancing with realtors at every weekend. Don't start doing that stuff. I mean, just be careful. that keep your compliance, keep honest, be the institution of reputation that you have always been, because that is going to matter most. And by the way, we have always seen that when a next administration comes back to power, they will look backwards and they will bring to the table those that have been the worst, and they will engage in enforcement later down the line. So I would just suggest that, even though we're going to see a relaxation and we're going to see maybe some of the regulations go away, we're going to be allowed to engage in a little bit more creativity as we serve the families in our communities. I think you have to maintain a line of compliance and a line of righteousness that will be seen forward. So again, this is going to stay, and I think that there's a few elements. The Bureau has already asked and is engaging in conversations about asking us what to remove from the regulations and what to keep. I think that this is a conversation that's going to move forth. I can go into that with some detail, but I think it's just important to realize that it is a big concern that the CFPB is pulling back, and a lot of our guys are asking, "My God, what's happening?" Because we need rules for this race that we're in, and the CFPB has provided those rules. I just want to add here the message that as you see the confusion, as you see things happening, as you see maybe some rules, some guidances are going away, we're not sure what we're going to do in terms of X or Y program. Within this confusion, just remember, we've been through this before. We've been through confusion before, massive confusion, Rich. We've been through a world where we didn't know how to comply with the rules that were being issued by the CFPB. You remember TRID? Do we
Oh, yeah.
remember TRID? That was what, 2014? Do
Yes.
we remember? And I had to pull a notice that we sent to our membership when TRID first became law. We had to issue a note to our bank membership to tell them their the compliance systems that have been delivered to you are invalid. A lot of them are just breaking down because they can't handle what they need to handle. They're not connecting to the core. There were all sorts of problems. We were getting all sorts of issues just with the compliance systems. Number two, the rules did not address all the situations, and they didn't answer the questions, and we couldn't get to proper compliance because nobody knew what they were doing. The rules were unclear. The rules were incomplete. We didn't know how to do construction to perm. We didn't know how to do various sort of whole transactions that were part of our portfolios. We didn't know how to engage in that. And so we had to tell the membership, we have no answers for you. The CFPB has no answers for you. We're going to have to advance day by day. And by God, we did. And I think that that's the important message. I think as we get into this confusion, you, Rich, and you, Rob, are going to be so much more important to our community. The ABA, the American Bankers Association, the Mortgage Bankers Association, we're going to continue to have our meetings. We're going to continue to have our peer conversations. But this conversation that we're having now, this is precisely what's going to get us through. I think as we head into lack of clarity, I think what everyone listening here has to remember is that this is where you're going to get the clarity. Even if we tell you there is no clarity, at least now you have clarity that there is no clarity, right? And I think you can go back to your institutions and you can say there is no clarity, and I can say that with all clarity. I can tell you with assuredness that we don't know how to do this. However, the industry is advancing day by day, and we will advance day by day. This is how we did it in the very, very, very dark days of the Dodd-Frank reforms. I will also remind you of QM, right? I mean, who knew how to comply with QM when it first came out? We didn't know where those cables were leading. So this was all a massive mess, but we got through it. This is going to be the venue. And this is why I want to be here talking to you guys, because I'm going to rely on you. I'm going to get information from you guys about what's going on out in the industry, but it's not going to be necessarily about reading the rules and the regulations every day. It's going to be about the opinions of experts and sort of the constructive voice of all of us together coming in and just discussing what's happening so that we can all have better conversations with government and we can advance as a pack. I think that's a very important message to everyone.
This is the big picture, presented and sponsored by our friends at Depth. And this week, Rob and I are very pleased to be joined by the American Bankers Association Senior Vice President over Mortgage Finance, also with long stints at the MBA and HUD, Rod Alba. Rod, you mentioned the administration has been reaching out to your group for feedback on regulatory reforms and rollbacks, which is great news. Anything to tease there? What's at the top of the list of the member base?
Yeah, I think so. We have a lot of reforms that we want, right? And the OMB just sent out a request for information about what are the reforms, what are the things that we can just repeal. What are the laws that are hurting? Where are the laws that overstep? What can we just repeal? And so the industry about 2 weeks ago submitted comments. The Mortgage Bankers Association submitted very good comments. We submitted comments as well. The American bankers did as well, even though we focus on all elements dealing with banking, so it wasn't specifically focused on mortgages. But we asked for a lot of elements to repeal. And I'll tell you, this is going to be a two-part delivery of what happened. Number one is we had a lot of issues that we are focusing on. For example, can we remove that 10%? Can we remove the tolerance rules from TRID? Can we just come back to a good faith estimate? Maybe where we do a 10% tolerance across the board, but stop it with this zero tolerance. Stop it with all of these divergent tolerances that apply to all these fees. We know that the complex procedures that we need to comply with that, for example, cost on every loan, I believe that the calculation is it costs about $1,200 to just comply with that one element of TRID, right? Can we remove that? What about that language preference? That language preference question that is in the that is imposed by Fannie Freddie and the FHFA. Can we remove that item? What's the worth and what's the value of that really in the transaction? What about the overtime compensation rules for LOs? Can we just become exempt again? Why do we need to sort of, go around and, clock in overtime? What about the LO compensation, under the Truth in Lending Act? Can we sort of save the deal, if you will, by discounting what the LO makes in any transaction so that we can have a deal and we can sort of negotiate better in favor of our customers and consumers. So these are a lot of the big issues that we have on the list that we're going to be advancing. The 3-day delay under TRID. Again, if I may return to TRID, do we really need these delay periods within the origination process? All of these things are there, and we're going to be advancing them. That has been a big priority in identifying these items. I will tell you that the ABA, however, stayed a little bit quiet in this round because what the government wants to do is repeal. What we need is not necessarily a removal of all the laws, but rather the creation of good regulation, good laws, good rules that allow all of us to understand what the playing field is, allow the consumer to be protected, but that requires us to write regulations. So, we're in this odd situation where simplification and deregulation actually requires regulatory rule writing. It requires us to take away some of the rules, but we have to replace them with better rules. And so rather than engage at this point in this just sort of massive repeal of regulations and tell us what to repeal, we're being a little bit more careful and we're going to go in and ask for, a surgery rather than ask for sort of a cutting off of the pieces of the regulations and rules. That's going to be an important process going forward. We're going to have one chance at this, right? We got 4 years. I think that the race is on now to get it done. So that's a huge priority for the mortgage side of the American Bankers Association, and we're talking to all of the representatives out there. Again, the mortgage bankers and the realtors and the ALTA, the American Land Title Association. So I think we're going to see good results at deregulation in the coming months.
And it may not be for you. It may be a year and a half. We know the track record on sitting presidents, what happens on midterm elections, typically not good for them. I think that's a big part of the reason why, President Trump being so aggressive so early in he's talked about it before, just, underestimating the midterms, his first term, and just how much it hampers your ability to get things done if you don't have the control that they have now. The competitive climate, Rod, interested to get your take on just the competitive climate right now, how bankers are looking at it. I've been saying on this show for a while, I feel like depositories are in a great position to pick up a bunch of market share. I think all these big lenders getting bigger, more community-centric lending, I think is going to have a little bit more appeal. You've got also construction lending, obviously going to be a bigger part of the pie these next few years. Still very, very difficult for independent mortgage banks to write construction loans. I think in 2010, depositories were doing 70% of the mortgage volume in America. Last year, 17%, IMBs, 83%. How does the
Yeah.
banking, the mortgage element from the banking community, like look at that? And do they look at the years ahead of us as opportunities to kind of grow, pick up market share, pick up talent?
It's interesting. We're worried about it, and I think systemically everyone is worried about it because I think that having a bank that has deposits, that has huge amounts of capital, is important for the health of the system. So we're worried about it, and we have concerns. At the American Bankers Association, when you talk to bankers, however, and this is very interesting, banks say, yeah. Yeah, we're making money elsewhere, and the benefit that banks have is that they can shift, right? They don't have to necessarily do mortgages. They can go to something else. If the regulations become too difficult, too expensive, maybe they'll cut it out for now and they'll return. Maybe they'll pick up other elements. So I think to some extent it's cyclical. The worrying part is that it really is regulatory burden. It is reputation. It simply can't be that everything and every mistake that a bank makes when you get into oversight, and your regulators come to visit your office. It can't be that everything that you have turns into fair lending violations. It can't be that that you're a constant target for even technical mistakes. I say all the time that I wish that in 2025 we actually knew what fair lending is. What does discrimination mean in America? We don't. The rules don't well define discrimination. I'll tell you, if I'm providing translations to the Spanish speaking population in my region, am I discriminating? Because I haven't also come up with Chinese translations that may not serve a smaller portion of my community. We don't know. That is an open question. So I am not going to serve the Spanish speaking population because I may or may not have to serve other populations that I may not have enough customers on that side. But that will be viewed, of course, as disparate impact, and it will be viewed in a different way. So there is this reputational element in mortgages. It's very difficult to come into compliance and sort of mix it into all your other operations. But I think that banks are beginning to come back in, are beginning to serve their community, and understand. I think that we understand that mortgages is becoming has always been important. What's very interesting to me is two things: the development of this mortgage in a box concept, where the lending institution may offer a product, but it's a product from an independent. It's a product that is being completely managed, underwritten, and sort of processed by another entity. That's coming in with a lot of force. The other element that I think is a huge unknown, it's also at the top of the sort of concerns, or at least the important issues identified by my committee, is AI. I guess I don't have to say it. I think that we all know it's redoing everything. It's a new world. We don't know how to use it yet. Many of our institutions don't know how to use it. It's sort of like Aladdin coming out of the lamp and saying, you got 3 wishes, and you really got to think about it because AI is telling us you can do whatever you want. We can talk to consumers, we can do calculations, we can do anything that you want. And so we're sitting here as, the person that is looking at Aladdin and saying, my God, I don't know what to ask for, right? And also, we don't know how it's going to restructure our sort of communications with our communities, or how it's going to restructure our communications with investors. So that's a big issue. And I got to tell you, that's going to be on the table. It's developing quickly. It is upon us. Even as it is developing, it's upon us. And I think a lot of us are very confused about that still to this moment.
Good stuff. And Rod, want to thank you so much for coming on the show today. This was great. Really appreciated your insight and perspective on the mortgage market from your unique seat. And yeah, one that'll really be critical to just the mortgage finance system in America as we move forward. So yeah, we wish you all the best in your role, and yeah, just your dealings with the members and the different government entities you're dealing with. And really appreciate you making some time to come on the big picture today.
Thank you. And I'll be
Rod
part of
should
the
be on here
audience.
next week. Part two next Thursday.
Yeah, absolutely. So, and to our listeners, thank you very much. If you're watching on YouTube or listening on Pod, where most of you digest this, we do the show live every Thursday at 3 p.m. Eastern. You can go to chrismancommentary.com to get signed up for the live show, which is always very fun. And want to thank you for taking some time out of your week to join us. So, and
Thanks for the
Rob,
depth.
and thanks to our friends
Thank
and
you.
partners at Depth, and
Thank you, Rich.
thanks to Rob, thanks to Rod, and to all you for making some time today. So have a great rest of the week and weekend, everyone, and we will see you next Thursday on The Big Picture. Take care. Thanks,
Thank
Rod.
you.
Thanks,
Thank
Rod.
you.
Bye.